Let's welcome on board Nilesh Shah, the MD and CEO at Envision Capital, joining us on the show. Nilesh, hi, good morning. This is Anisha this side. Just wanted to begin by taking your view as far as where the market is headed. We were having those all-time high-level insights, just 100, 200 point away on the Nifty. Do you see that happening soon in the month of June itself?
Yeah, I think it's a great opportunity for the markets to advance further. We've had some strong tailwinds in terms of the macro data which has come out. We've had some solid growth. Inflation is tapering. So pretty much looks like a Goldilocks situation from a macros perspective. We've just completed the earnings season. I think it's been a great close to the quarter, great close to the financial year from corporate India. The liquidity overhang, which was there in terms of the FPI selling most of late 21 and 22, that trend has reversed and they are net buyers. So on the whole, I think a solid set of fundamentals and strong liquidity, I think, are the perfect kind of tailwinds that the markets would really look forward to. And post the market consolidation for the last 18 months, the valuations also have turned relatively reasonable. So on the whole, great fundamentals, solid liquidity, and reasonable valuations. I think that really provides a lot of support and a lot of push for the markets to continue to move forward.
Fair enough, Nilesh. Hi, morning. What do you think is going to be then the next big trigger that the markets will watch out for? Do you think it's largely likely to be domestically led back home, or do you think that it'll be a combination of factors from across the globe as well?
I think it's going to be a combination of all. I think we are today relatively spoiled for choice because the domestic growth momentum is very solid. There's strong growth that we are seeing essentially in a lot of discretionary consumption items. The investment and the capex cycle, which is still kind of just begun, is showing against very, very strong momentum. So you have both discretionary consumption as well as the investment in the capex cycle, which essentially are unfolding. In addition to that, if inflation has started to moderate, it's quite possible that we are already on a pause mode, and if the rates start to decline, that will give a further boost to a lot of rate sensitives like real estate, automobiles, and some of the other rate sensitives. In addition to that, from a global perspective, while there is a slowdown and there will be challenges in terms of exports, but selective pockets across the board, I still think are poised to do well. Some of the companies have evolved some really specific business models and are making them increasingly relevant to the global supply chain. So I think it's going to be a combination of rate sensitives, discretionary spending, capex, investment plays, and selectively export or global plays. I think a combination of all of this are expected to outperform.
Combination of a lot of factors, but what's also impacting the market at this point of time, Nilesh, is the clear divergent moves coming in the broader markets versus large caps. It's the mid-cap and small caps that have been outperforming, while the likes of Reliance, HDFC twins, they have really failed to participate. What's your view on Reliance and the HDFC twins at large?
Well, both the packs have consolidated quite a bit, and clearly we see a lot of value emerging there. Especially the HDFC twins, they basically are currently countering a bit of a technical overhang in terms of what the MSCI's decision was in terms of the inclusion and their respective weights. So that is an overhang, and the merger is just around the corner. So I believe that maybe for some time these overhangs may persist, but I still believe that the earnings season, I think, has been great for both of them, and you seeing them to kind of become more reasonable on valuation. So I think they are attractive for a long-term investor. We own these in our PMS, so we have a vested interest.
The vested interest, but what are you doing with your positions? Are you looking at this consolidation as an opportunity to add, or you're just holding on to your position?
We are holding on and adding as well. So we're using these essentially this phase of consolidation or even bit of the declines to keep adding to these positions, because we still believe that these are really some strong giants. They are stalwarts, and they continue to kind of deliver cutting edge products and services. So to that extent, on the whole, we really like the long-term investment thesis for some of these established companies.
Nilesh, anyone who's everyone is just betting on the entire manufacturing theme, talking about how this is the next big sector to bet on when it comes to India. I'm sure you too have jumped onto the bandwagon. Tell us a little bit more if you have, and what exactly is it that you would look at from a market standpoint?
Well, this decade should witness the emergence of India manufacturing. Lots has been done in the last 5 to 7 years to make Indian manufacturing competitive. And these reforms are essentially going to propel India's manufacturing to new levels and new heights. For many decades, the share of manufacturing in our GDP has essentially been either falling or has been abysmally low, and it's time for the manufacturing sector to catch up. And thankfully, several policy measures and reforms have been unleashed in the last 5 to 7 years, which make Indian manufacturing very competitive. So in addition to the China plus angle, I clearly believe that it's become imperative for global supply chains to de-risk their outsourcing, and India clearly is a very strong destination. We've seen some really big players come in and expand their manufacturing and outsourcing from India. The likes of Apple, Tesla is continuously knocking on the door and evaluating options. And in addition to some of these really technology or the new age companies, we also seeing manufacturing pick up strongly in chemicals, pharmaceuticals, auto components, defense. These are some of the areas where Indian manufacturing is really becoming the focus of the world. So I think on the whole, manufacturing is a huge canvas. There are several sectors, and we really see majority of these sectors to do well. And especially with the kind of cost proposition that some of the Indian manufacturers have to offer, we think that a combination of a strong domestic opportunity, import substitution, and export promotion, I think are really wonderful kind of areas to look for from an Indian manufacturing point of view.
Nilesh, I also wanted to talk to you about the fact that you have quite a few positions when it comes to the liquor industry. You owned at least United Spirits, Radico Khaitan. You were looking at Sula as well. What's the update with respect to that? And I'm also keen to understand, what's the view on pharma? Are you looking at it incrementally positive?
Firstly, on the alcoholic beverages, we're extremely constructive, extremely positive on the Indian alcoholic beverages segment. We pretty much think that this sector is pretty much like what consumer staples like soaps and shampoos were 10, 20, 30 years back. Underpenetration is abysmally low, and we have a lot of headroom to catch up. So there's a solid case for these businesses to kind of compound or grow their volumes in high single digits and value in mid double digits. So we clearly believe that this is an extremely attractive opportunity. We used to own United Spirits as well as Radico. We continue to own them. And we have most recently added Sula, as it is the market leader in the wine segment, which is still kind of very, very nascent and in very early stages. So we own these three positions in the Indian alcoholic beverages, and we think it's one of the best proxies for Indian consumption story. And as per capita incomes rise, we actually believe an increasing consumption of some of these discretionary products. So clearly continue to be very positive on that. Secondly, is in the liquor segment, we think margins have bottomed out. And when we kind of look at the guidance which some of these companies are giving, they're talking of getting back to their historically high margins over the span of next few quarters or next few years. So that will provide additional tailwinds to the growth for these companies. Coming on to pharma, I think pharma has so far been a very disappointing experience. They continue to face some strong headwinds in terms of price erosion, especially for the US markets and some of the regulatory issues. So I still think at this stage, we're not as constructive on pharma as what we used to be a while back. But let's see how things unfold. If some of these headwinds recede, then we're willing to kind of have a fresh look at Indian pharma.
That's about the dawa and the daru, but Nilesh, what's the view on food, etc. as well? And I'm talking about the fact that if you're having too much daru, you need the insurance policies from the likes of PB Fintech and probably some chakna from the likes of Zomato.
Oh yeah, absolutely, Alisha. These are really the kind of opportunities that we're looking for. We like the insurance space, and we clearly believe that Indian insurance is again significantly underpenetrated. Our per capita spending on insurance is just about $80 versus a global average of $800. So that gives basically headroom for growth for several years or maybe for a decade or two. And within that, online insurance is again relatively underpenetrated, or the share of online insurance is still very low. it's still probably 1 to 2% versus maybe 5 to 10 to 13% for countries like China and the United States. So clearly, there's a very strong, compelling growth proposition for online insurance. We have been liking PB Fintech. We continue to own PB Fintech. On the food side, yes, clearly we still believe that the food basket itself of the average Indian consumer is changing, and some from the basic staples, I think it's moving on to some of the different kinds of foods. And I think within that, we have been owning Pratap Snacks for a while, and a year back, approximately, we'd added Mrs. Bector as well. And we continue to like these, though of course post the run-up, the valuations have gone on to a bit of the higher side. But let's see. I think on the whole, we like these kind of opportunities where the plate of the Indian consumer is changing, the consumption basket is changing, and we're continuously evaluating opportunities on them in this space.
Daru and snacks in the portfolio, so hopefully it's going to turn out to be very tempting returns overall. But Nilesh, let's talk IT as well, because you have said in the past that Tech Mahindra, has the pedigree of the M&M group, so that's a stock that you're looking at. What else have you been adding when it comes to Midcap IT?
Well, we haven't yet, invested in Tech Mahindra. We continue to evaluate it. It's on our radar. Yes, we like the fact that it's part of the M&M group. So I think the pedigree is fantastic. They clearly have an edge in the telecom space, but yet that has yet to translate into industry-beating numbers. Going forward, there is a change of leadership, and sometime you're going to see a new CEO take over during the course of this year. So we'll really see what he has in store for Tech Mahindra and its growth prospects, and whether he's able to really catapult Tech Mahindra into a new growth orbit. So we continue to basically still watch that space and watch the company. So let's see. In the mid-cap space, we continue to like the entire mid-cap space. I think there are some really compelling opportunities, of which the most constructive that we are on is been LTTS. We've been owning it now for a while. We continue to like what they do in the engineering R&D space. However, there have been a couple of developments which are likely to kind of, in a way, flatten their growth maybe for a few quarters before they really catch up with their past historical averages in terms of both growth as well as margin. So we continue to like that for what they do and the leadership there. And we continue to evaluate many other mid-cap and small-cap IT companies.
I want to come back to the point that you were talking about in terms of consumption, how is underpenetrated, and we have seen that the luxury end of the market and the per capita income increasing, that entire wealth effect is having an impact on the trends in consumption as well. So how would you like to play this with respect to real estate, if at all, and autos?
So real estate is essentially a sector which is really poised for much better times. We think with softening in commodity prices and inflation lowering, interest rates are probably have either peaked out or are likely to kind of trend lower, which I think is going to be a stimulus or a catalyst for the real estate sector. The sector itself has gone through consolidation for the last 9 to 10 years. And we think that, like any other sector, this sector is also expected to emerge out of this consolidation phase. So we are constructive on the real estate space. So far, the luxury segment has done well, but we believe that with broad-based growth, pickup in manufacturing, wider job creation, we think that now the affordable real estate space or the mid-income real estate space is also expected to play a catch-up to what the premium of the luxury end has been doing. So we think on the whole, the real estate space, I think, again, is a great proxy for both India's consumption potential as well as in the short to medium term on where potential interest rates could be headed. So I think we like the real estate space.
I know we did touch upon PB Fintech, Nilesh, but just curious as to whether or not, any of the other upcoming IPOs or some of the other, new age tech companies are appealing, or what your view is as a whole.
So, Aman, that's an interesting question. That's a great question. And I think we are excited about, the potential for some of these new age companies. And we have been constructing on the space. But I think when we have continuously evaluated them over maybe the last 6 to 8 quarters that they have been listed, earlier on, they were just focused on growth. And in the process, they were essentially incurring losses and maybe having cash burn as well. They have recalibrated their strategy, taken a few steps back, and chose to focus more on profitability, which is good news, because I think respecting the balance sheet, I think for us is a very, very important tenet of running a business. But having said that, I think it's impacting growth for some of them, and I think in the most recent quarter, some of them have kind of reported a tad lower growth than what you would want to expect them to do. So let's see. I still think that some of these new age companies are still in an experimentation mode, and I think are trying to kind of still dabble between profitability and growth. So let's see. We're watchful of the space. The moment we basically we get answers to some of these questions, I think we would probably have more of them in our portfolio.
What about the entire capex-led industrial growth theme that is playing out in the market at this point of time? The likes of L&T, the industrials, Thermax, Cummins of the world. Something on your radar or not really?
Oh, absolutely. We've been very constructive on the entire capex cycle now for more than a year, maybe a year and a half. And we've had some really interesting picks out there. They've been part of our portfolios, and these have done well for us. So we like the space, just that in the entire capex space, we are more inclined towards the product companies or the equipment companies versus, the pure services companies. So I think that's where we have gravitated towards. And we own a bunch of them, which are proxies for power sector, energy sector, railways as a sector. So I think we own a fair bit of these capex companies, and we have a fair exposure to them.
Which are those names, if I may ask? You own a bunch of them, so at least name a few.
Well, we own KSB Pumps, we own Hitachi Energy, we own TD Power. These are some of the names that we own. We used to own CG Power, but we have exited CG Power, given the kind of sharp run-up that CG Power has witnessed. So I think we own a bunch of them.
So you're talking positively about a whole host of sectors, Nilesh. So what's the space you are underweight on at this point of time, or something that you will stay away? What stands out?
I think I'm not too sure about where we're staying away from, but where we are underweight are, the chemical space. We are underweight the pharma space. We are underweight the large cap IT space. It's not that we don't have exposure here, but we do have exposure. But I'd say that we're probably significantly underweight on these sectors. We are underweight yet on PSUs as a pack. We are underweight on the large cap banks. We do have positions, but I think we're relatively underweight on the large cap banks as well.
So when you say you're staying away from PSU names, is it specifically PSU banks as well? Because that was the darling of the market in the year gone by. Solid rally. What's keeping you away?
Yeah, so PSU banks as a space is something that we've stayed away from. It's probably because we had sufficient choice in private sector banks across large banks as well as mid-sized banks. And some of the mid-sized to small-sized banks have essentially done probably as well, both in terms of their operating and financial performance, as well as in terms of stock price performance. So honestly, we have been able to participate in the overall banking space. It's just that because of that, there was choice in terms of the private sector names. We've been in the private bank space, and we have fair bit of exposure in terms of the number of names out there as well. It's just that we have a more balanced exposure in private banks towards both large cap as well as mid cap banks.
What about metals? Is that a space that you're steering clear from?
Well, absolutely. I mean, we've, one sector or one space that we stay away from is commodities. We really have no wherewithal to predict where commodity prices are going to be and how that would translate into growth and earnings for, commodity producers. So we've stayed away totally from commodity companies, including metals or crude oil producers. And by and large, we've stayed away or have been underweight on some of these cyclicals as well.
Come back to your point when you mentioned that real estate is one of the best proxies to play the consumption trend also at this point of time. What are those names? Are you playing it specifically with respect to some micro markets? And is it, trickling down to, let's say, the cement, the building material, the consumer durable names as well?
Yeah, it's a combination of all of these, what you mentioned. So we've been owning Kolte Patil in the real estate space now for a while. And we continue to like in terms of its execution, what it's been doing in micro markets like Pune and some of the emerging markets like Bangalore and Mumbai for it. So I think we like that. We like its business model about redevelopment and an asset-light strategy. So I think we've been constructing there. Most recently, about a few months back, in building materials, if you call it building materials, we'd added a laminate manufacturing company. So that's done well. It's delivered strong performance. We also own a housing finance company called Home First. It's in the affordable housing segment, I think doing incredibly well in the outskirts of tier 1 cities and in tier 2, tier 3 cities. It's been growing at a ferocious pace, managing its asset quality well. And it has sufficient capital to essentially grow at these kind of rates for maybe the next 3 to 5 years, with ROEs continuously improving. So we own that as well. In consumer appliances and consumer durables, we've been owning TTK Prestige. Demand, of course, has been somber for this space, especially the kitchen appliances space, with margin pressures coming on. But we think that probably things might start to look up sometime during the second half of this financial year for some of these kind of companies, the consumer durables, as growth picks up and margins begin to kind of start to lift up. So I think we have a pretty comprehensive exposure in terms of real estate developers, housing finance companies, building materials, as well as consumer appliances companies, as I think an overall aggregate proxy for real estate and consumption in India.
Things looking good. I think the entire hospitality QSR space has been a very promising sector of late. Do you own anything within this space? Can you just highlight the themes?
We don't directly own any of the QSR names because some of them are either loss-making or some of them trade at some really lofty valuations. And our strategy is more about trying to kind of buy into growth at more reasonable or favorable prices. But the way we've participated in the QSR space is to be through a proxy play. So I earlier alluded to Mrs. Bector, which of course has the biscuits business, but also has a very interesting bakery business. And they supply, buns and some of the other bakery products to most of the leading QSR chains in India. So to some extent, we have proxy to the fast-growing QSR space of India.
Nilesh, on that note, we let you go. Really appreciate you joining us and helping us decode all that's going on as far as Envision's mind is concerned in terms of which are the sectors that look good and which are the ones that one should stay clear of.
Thank you. Thank you.
Thank you.